They call it capitalism. But you know it's a war.
In the 1990s, home entertainment was dominated by one colossal entity, Blockbuster Video. Operating as a near monopoly, its physical distribution network was unrivaled, with over 9,000 stores worldwide. The data clearly indicates a systemic issue. This isn't just a loss, it's a deliberate act of financial manipulation. The data indicates a significant anomaly, a pattern that points towards manipulation on a massive scale. This could unravel everything. However, a fatal flaw emerged. Blockbuster profited not from satisfaction, but from customer mistakes. The financial markets are reacting to the unprecedented shift in global policy, and the implications for your investments are dire. This late fee concept was essentially a tax on tardiness, creating immense psychological friction. From a behavioral economics perspective, this was a long-term suicide strategy, constantly punishing customers. In 1997, Netflix emerged, offering DVD rentals by mail with a subscription model. No deadlines, no late fees. The dot-com bubble burst in 2000, and Netflix, cash-strapped, faced record net losses. Their legacy will be devoured. We won't let you erase us. Their proposal? A $50 million merger, a lifeline during the crisis. I understand the projections. I simply don't find them compelling enough. Blockbuster, a multi-billion-dollar giant with tangible assets, saw Netflix as a tiny, failing dot-com. They were blinded by sunk costs, billions invested in physical infrastructure. Acknowledging Netflix's online future would invalidate their colossal physical assets. Antioco confused current scale with future growth velocity, a critical misjudgment. Between 2002 and 2005, macro infrastructure shifted. Broadband internet exploded across the US. The numbers don't lie. This financial crisis is unlike anything we've ever seen. Economically, this move optimized their marginal cost to near zero.
To serve 1 million new customers, Netflix only needed server upgrades, low cost. Blockbuster needed new stores, staff, discs, extremely high.
The economic battlefield changed. Blockbuster found itself caught between past and future. When Blockbuster attempted its online counterattack, they faced the innovator's dilemma. To compete, they had to abolish late fees. But doing so meant losing $800 million in vital revenue. They were trapped, unable to abandon the past, yet unable to embrace the future.
There are always winners, and there are always losers. This is the story of the latter.
By 2026, Netflix had become a global cultural institution, valued at over $250 billion.
This saga offers 3 invaluable economic and management lessons for the 21st century. Lesson 1. Businesses don't die from strong competitors, but from toxic cash flow structures.
Blockbuster's profit came from customer inconvenience. Netflix built theirs from creating value.
The evidence suggests this market manipulation was deliberately orchestrated. The data doesn't lie.
Build cash flow by creating value, not by exploiting customer errors.
Lesson 2. The evolution speed of macro infrastructure always crushes conservative business models.
The year 2000. Unlimited potential. The year 2005. Irreversible consequences.
Technology develops exponentially. Fixed physical asset models lack the agility for rapid tech waves.
A business model tied to fixed physical assets cannot transform fast enough when new technology sweeps in. The tidal wave of high-speed internet, or AI, will always engulf the unprepared. Mispricing innovation is the most costly mistake any leader can make. The $50 million for Netflix in 2000 was cheap future insurance, a negligible investment. Tiny thing. What are you even for? Instead, look at the technology's slope and the market pain it's solving. The video rental giant's empire in the 1990s was built on unmatched physical distribution, operating like a near monopoly. The data clearly indicates that the merger is the only viable path forward. There is too much at stake to hesitate. Hi there. We're introducing a new feature where I can read this aloud in a natural, human-like voice. These impulse buys, like popcorn and drinks, boosted their net profit margins significantly. But the Achilles heel was its revenue structure. Profits from customer failure, not satisfaction. By 1997, late fees alone contributed an astounding $800 million annually to Blockbuster. The data shows a massive imbalance. The golden opportunities for the elite are built on the fragile spines of the many. Behavioral economics warned constantly punishing customers built deep-seated psychological friction. Netflix launched in 1997, disrupting with mail-order DVDs and a penalty-free subscription model.
Then came the dot-com bust of 2000. Netflix, financially crippled, saw its losses mount.
Desperate, the startup founders approached the established company's CEO.
They offered a merger for $50 million, a chance to secure Blockbuster's future.
Antioco, dismissive, rejected the offer, a decision steeped in economic fallacies.
His perspective, colored by survivorship bias, favored Blockbuster's massive, tangible assets.
He fell prey to the sunk cost fallacy, valuing existing physical wealth over future potential. The billions poured into physical stores and media created a blindness to digital innovation. Antioco couldn't fathom how a tiny .com could outpace his brick-and-mortar empire. The year 2008 wasn't just a recession, it was a reckoning, a catastrophic failure built on leverage, deception, and unchecked ambition. Netflix pivoted, abandoning physical mail to embrace the nascent streaming era. This digital leap gave Netflix an unparalleled economic advantage, near zero marginal cost. Adding 1 million Netflix users cost little. For Blockbuster, it meant immense physical expansion costs. The economic landscape had fundamentally shifted, leaving Blockbuster behind. The data indicates a significant anomaly, a clear sign of the systemic instability we warned about. We must act now to mitigate the potential fallout. Removing late fees, crucial for online competition, meant losing $800 million of core revenue. They were caught between two worlds, unable to let go of the old, unable to grasp the new. The empire fell, and now only the silence and the dust remain. The markets are volatile. Our position in global technology has never been stronger, but the future is uncertain. 3 crucial lessons emerge from Blockbuster's rise and fall. First, toxic cash flow, built on customer pain, leads to eventual self-destruction. Customers hate being punished. Build value, not resentment, into your revenue model. Second, macro infrastructure evolution crushes static business models. Exponential tech spares no one. The data shows a massive shift. A tidal wave of change is coming to the tech world. Business for this technology. Third, misvaluing innovation is costly. $50 million was cheap insurance for the established company's future. Future leaders must assess a technology's growth trajectory and its pain-solving capacity, not just current earnings. Thank you for watching Magnate's Ledger. What insights did you uncover? Share your thoughts below. Subscribe for more exclusive business secrets. Join us for deeper insights. Until then, stay curious.